Welcome to CoreLogic's update on housing market conditions for February 2018. CoreLogic reported further slippage in dwelling values over the first month of 2018, with the national dwelling values recording their second consecutive month-on-month decline. After dwelling values held firm in October and November, they slipped by 1/3 of a percentage point in both December and January to be down 0.7% from their peak. The fall in national dwelling values was broad-based across the capitals, but continues to be led by Sydney, where values were down by almost 1% over the month to be 3.1% lower since their peak back in July last year. Month-on-month falls were recorded across every capital city, except for Brisbane, where values were steady, and Hobart, where dwelling values continued their strong run of growth, surging another 1% higher. Looking at the annual trend in housing performance, the two largest capital cities are the main drivers behind the slowdown. However, most other capitals have also experienced some softer growth conditions over recent months. Sydney's annual rate of growth peaked at 17.1% in May last year and at 13.1% in July for Melbourne. Current annual growth rates in both cities are substantially lower than their 2017 peaks, which highlights the significant slowdown over the second half of the year, which has continued into early 2018. Interestingly, the weakness in the housing market is most concentrated at the higher value end of the market. Segmenting CoreLogic's Hedonic index into deciles reveals the most expensive 10% of national housing markets have seen dwelling values fall by 2.7% over the past 3 months, while falls were recorded across the 8th and 9th deciles as well. Growth has eased across the more affordable value deciles, but remains in positive territory. This trend of weaker housing market conditions across the premium sector of the market is most evident in Sydney and Melbourne, where affordability constraints are the most prevalent, and a surge in first home buyer numbers, thanks to stamp duty concessions in these states, is helping to support demand at the lower end of the valuation spectrum. The opposite is true across the other capital cities, where housing affordability is less pressing and there's been no change to first home buyer incentives. As the housing market transitions away from growth, the number of buyers has eased off. National settled sales were 6.3% lower year on year, the result of both tighter credit policies as well as lower housing market sentiment and affordability constraints. Settled sales recorded the largest annual declines across Melbourne. They were down 11.7% compared to the previous 12 months, while Sydney and Brisbane also recorded a substantial fall in settled sales. On the other hand, residential property sales were higher across Darwin and Perth, albeit from a low base, as well as trending higher across Hobart. Outside of the capital cities, regional New South Wales continues to show the highest rate of annual capital gains at 6.8%. However, the rolling quarterly trend is now easing as large markets like Newcastle and Wollongong start to follow Sydney's lead and have moved through the peak rates of growth. If this trend continues, it's likely that regional Victoria, where the quarterly trend is actually accelerating, could take over as the fastest growing regional market on an annual basis. Regional Tasmania is also showing a strong upwards trajectory as growth ripples away from Hobart. Regional areas of Queensland and South Australia have moved into positive growth territory over the 3 months ending January. That's the first positive quarterly shift in dwelling value since May 2017 across both areas. Regional Western Australian dwelling values continue to trend lower, and values are generally substantially below the 2014 highs. In a sign of improving conditions, the annual pace of decline has improved relative to a year ago as commodity prices push higher and labour force conditions continue to strengthen. Let's take a look around each of the capital city housing markets. The decline in Sydney dwelling values has continued, with a further 0.9% fall in values in January 2018. Sydney values are now 3.1% lower than the July 2017 peak. There are a variety of factors contributing to the slide in Sydney's housing market conditions. With values up 75% between February 2012 and July 2017, the city has seen affordability deteriorate. Additionally, the most significant source of recent housing demand has been from investors, who are now incurring higher mortgage rates and stricter servicing criteria. Credit rationing is also limiting the availability of interest-only mortgages. Additionally, interstate migration out of New South Wales is accelerating, which is detracting from housing demand. As a result, it's expected that dwelling values are likely to continue falling over the coming months. Strong overseas migration and solid jobs growth, as well as low mortgage rates and higher first home buyer activity, should help to keep a floor under Sydney housing prices. For the second month in a row, Melbourne dwelling values fell by 0.2% in January, taking values 0.4% lower than their peak. After dwelling values surged 59% between February 2012 and November 2017, housing affordability is stretched, although it remains more affordable to buy a dwelling in Melbourne compared with Sydney. Melbourne continues to benefit from very strong net overseas and interstate migration, which should help to support housing demand. However, the moderate declines may persist over the coming months. With the recent slip in dwelling values against gradually rising rents, Melbourne rental yields have marginally lifted from their record low base, but remain the lowest of any capital city. Brisbane dwelling values were unchanged in January, and although they've increased over the quarter, the growth trend remains moderate. Despite a 0.1% drop in house values over the month, Brisbane's detached housing market has generally shown a much better result than the unit market, where values were down 0.7% over the past 12 months. Brisbane's housing market is likely to continue on a similar trajectory over the coming months, with interstate migration to Queensland accelerating and labour market conditions consistently improving, potentially leading to a modest uplift in value growth. Adelaide dwelling values fell by 0.2% in January. However, they edged higher over the 3 months to January 2018, and on an annual basis, dwelling values are rising at a slightly faster pace than inflation at 2.4%. Detached houses are returning a stronger performance than units, with values rising 2.6% over the past 12 months compared with a 0.4% lift in unit values. The outlook for Adelaide remains steady, with growth in dwelling values expected to continue roughly in line with trends over the past year. Perth dwelling values had been showing some signs of stabilising over the second half of 2017. However, dwelling values have fallen over the past 2 months, taking the market 0.3% lower over the quarter. Despite the recent fall, we believe the worst of the declines are now over. However, the market is expected to remain relatively flat over the coming months. Buyer demand has lifted off a low base, with the number of settled sales up 0.7%. Together with a 4.5% reduction in advertised housing stock, rising buyer demand is a strong signal that Perth's housing market is moving through the bottom of its cycle. The Hobart housing market is the strongest of all capital cities and has some significant momentum. Dwelling values increased by 1% in January to be 3.1% higher over the past 3 months. Interstate migration to Tasmania has picked up recently, and housing remains much more affordable than other capital cities. It will be interesting to see how long Hobart can sustain such a high rate of capital gains. Strong value growth will eventually dampen the affordability proposition, which is one of the key drivers of demand in this market. On the other hand, the supply of stock listed for sale remains historically low, which continues to fuel a level of urgency in the market and support value increases. Darwin dwelling values have been declining since 2014, with values falling a further 0.2% in January, taking the total decline since the market peaked to 21.7%. There is little evidence to suggest the slide in values is set to slow over the coming months, although transaction volumes have been moving higher, albeit from a low base. Growth in Canberra dwelling values has slowed compared to 12 months ago. Although values were 1% higher over the past 3 months, they fell by 0.1% in January, and the annual growth trend has eased from 8.8% in May last year to 4.5% over the 12 months to January this year. Canberra is currently seeing a reduction in sales activity, as well as higher levels of stock available for sale. Assuming that trend persists, it's expected that the rate of value growth will slow further over the coming months. The housing market goes a bit quiet in January, with overall transactional volumes dropping by about 25% between December and January. With this in mind, getting a firm reading on the housing market will become more straightforward as we progress through February. While dwelling values are now easing both at a macro level and across several of the capital cities, it's clear that Australian housing values aren't falling off a cliff. National dwelling values are down by just 0.7% over the past 4 months, after increasing by 41% during the growth phase. Strong jobs growth, falling unemployment, high migration levels and low mortgage rates will, in our opinion at least, help to support a soft landing in the housing market. Labour market conditions have generally been improving, with stronger jobs growth spreading outside of Victoria and New South Wales, particularly into Queensland and to a lesser extent into Western Australia. Stronger labour markets are likely to help drive confidence and support mortgage demand. If the trend persists, stronger conditions may help to push wages growth off near record lows, which would also be a positive influence on housing market conditions. We're also seeing strong population growth contributing to housing demand. Migration rates have been trending higher, which is likely to continue into 2018. Overseas migration into Victoria and New South Wales reached record highs in mid-2017, and interstate migration has been on a clear upwards trajectory across Victoria, Queensland, Tasmania and the ACT. With financial markets forecasting a 25 basis point lift in the cash rate by early 2019, there's an increasing chance that mortgage rates will rise from the currently low levels over the next 12 months. Even if the cash rate was to remain stable, there is the potential mortgage rates could be adjusted higher due to increased bank funding costs or in order to fulfil APRA's local implementation of the now finalised Basel III requirements for regulatory capital held against residential mortgages. Higher mortgage rates will test the resilience of the housing market, especially considering household debt is tracking at record highs. However, the likelihood of mortgage rates moving substantially higher remains low. Overall, we're expecting national housing market conditions will remain as diverse as ever, with particular sensitivity to credit policies and any changes in mortgage rates. If you'd like to take a deeper dive on housing market conditions and statistics, there's plenty more to be found at CoreLogic's website, located at www.corelogic.com.au.